Hello everyone, my name is Josh O'Connell and this is episode 7 of Irish Tax Unwrapped. Whether you're a business owner, an investor or just curious, we break down Ireland's tax code for everyone. Welcome back folks. If you missed our last episode, we broke down the complex world of property taxation. How something that should be simple has turned into a strategic game over the centuries. We explored its origins, how it shifted from taxing the aristocracy to today's intricate rules and the key legal battles that shaped what landlords and developers face now. But this episode, we're taking it to the next level. We're diving into real-world scenarios, from government contracts to VAT pitfalls and estate planning must-knows. Whether you're an investor, developer or property manager, these insights could save you serious money. It's been a great month for the pod. We've had a tremendous jump in listeners, which reminds me, if you're new here, please make sure to follow and share. You can find us on all major podcast platforms, including Spotify and iTunes. Let's keep growing this community together. As always, I'm joined by our regular tax experts, Derek and Daphne, who will help us make sense of it all. As usual, let's start by having a look at what's making headlines in the world of tax.
There's only one place to start, with someone who, if he was here, would boast about big crowds, loves green, and claims to have been chosen by God. Not that guy. St. Patrick, of course.
We're not just talking about St. Patrick, the man, the myth, the snake-banishing legend. We're talking about St. Patrick's Day in the grand tradition of Irish foreign policy.
It's that time of year, Josh, and Micheál Martin is heading to Washington. And with everything going on recently, I bet he's packed a 4-leaf clover and a bottle of whiskey.
Right, so Trump's threatening tariffs and targeting countries with trade deficits. That puts Ireland, a favoured holding company location outside the US, in his crosshairs.
Great timing. Ireland finally signs up to the OECD global minimum tax deal, and Trump swings in, hinting he might just yank American multinationals back home anyway.
So Martin is heading over along with Enterprise Minister Peter Burke and a small army of officials to keep the US companies from bolting.
Well, Josh, let's just hope that Trump's team hasn't been reading David McWilliam's latest blog.
He lays out just how much of an economic shock Ireland could be in for if Trump's MAGA crew actually take a closer look at US-Ireland relations, because if Micheál Martin walks in all smiles, only to find out that the Americans suddenly care about tax policy the way McWilliams predicts, well, let's just say it could be more snakes and ladders than smooth diplomacy.
We're all waiting to see if Trump will go into full protectionist mode, if he'll announce tariffs or other measures to strong-arm American companies back to the US. And let's be honest, Ireland's budget depends on tax money from Apple, Google and Pfizer.
Martin's job is to stop Ireland from losing its biggest tax contributors while avoiding an international incident with Trump.
Bingo. If he pulls it off, they should put his face on the next €50 note.
And if things go south,
we might not need €50 notes.
Maybe Martin can distract Trump with a chat about free speech. If there's anyone who knows how to be in government while claiming to be against it, it's Trump.
What do you mean?
Well,
he could change the conversation by asking his advice on how to let his independent supporters have speaking rights without technically being in opposition.
And if that doesn't work?
Then turn the conversation to the latest real estate craze in Ireland, granny flats.
Ah yes, Trump will appreciate this one on multiple levels. A real estate play that attempts to solve Ireland's housing crisis and has the added benefit of shaking down pesky garden dwellers.
And this one is particularly creative.
All right, let's break it down. The government, in a rare display of generosity, says you can now build a granny flat in your back garden without planning permission. Fantastic, right? But wait, revenue is already salivating over the tax implications.
The government feels that lessons have been learned from the past, specifically how to build bike sheds, and they've upped their game to promote the building of granny flats. The kicker: the second your granny moves in, revenue shows up with a property valuation report and a smirk.
Because if your new flat bumps up your property value by 150 to 200 grand, congratulations! You might be in a higher tax bracket or get slapped with a separate tax bill altogether.
Yeah, nothing says housing support like surprise charges.
Meanwhile, the government is throwing cash around like it's monopoly money. Billions on the Metrolink that doesn't exist. A children's hospital that could have been built on the moon for the same price.
And the security hut. A cool 250 grand for a tiny building outside Leinster House. At that price, it should at least have a jacuzzi.
In all seriousness, additional local property tax for building a granny flat? It's a bit much, isn't it?
So the message is build a granny flat, enjoy your planning permission holiday, but be prepared for more local property tax.
Okay, what else is going on?
Speaking of local property tax, I'd like to mention a case. A woman who's her son's full-time carer overpaid LPT by more than £2,000, but because of a legal restriction, she can't get it back. Her situation is dire.
That just seems wrong.
It is wrong, but unfortunately it's how the system works. Tax laws have strict deadlines, and in this case, there's a rule that stops taxpayers from recovering refunds if they don't claim within 4 years.
Think of it like a gift card. If you don't use your refund by the expiry date, it's worthless. Only this isn't a €50 voucher, it's thousands of euros.
But she's a full-time carer for her son. She wasn't sitting on extra cash. She just didn't know about the exemption. Shouldn't Revenue take some responsibility for making this information clearer?
Absolutely. Revenue does provide guidance, but tax rules aren't exactly bedtime reading. For someone like her, juggling round-the-clock care, it's completely unrealistic to expect her to stay on top of every exemption and deadline.
The system assumes people have the time, energy, and access to resources to figure this stuff out. But in reality, they don't.
So what's the fix? Couldn't they just backdate exemptions automatically if someone clearly qualifies?
That would make sense, wouldn't it? Less paperwork, fewer disputes. Revenue actually saves time. But right now, the laws prioritise strict deadlines over fairness.
And changing that would require legislation. The rules are designed to be black and white, but life is not that simple. Cases like this show why reform is needed.
It's just frustrating. You can hear the exhaustion in people's voices when they tell these stories. This isn't just about money, it's about fairness, about being treated with basic decency.
Exactly. And it's not just this one case. There are plenty of others in similar situations, and they don't even realise they've lost out until it's too late.
That's why awareness is so important. If enough people speak up, if cases like this gain traction, there's a chance lawmakers will take notice and push for change.
So is there anything she can do now? Any legal loophole, any appeal process?
Realistically, no. The law is clear on this. If you don't claim within 4 years, the refund is gone.
But she can push for a change. Contact TDs, raise awareness, get the public talking. That's how unfair systems get fixed.
It's just so frustrating. People like her already have enough on their plates. Why should they have to fight these battles too?
They shouldn't. But cases like these expose the cracks in the system. It's up to all of us to keep the pressure up and push for reforms that actually help people.
We've been thinking about this and we have an idea. We're planning a submission to the Department of Finance to reform the rules. We believe the law should be amended to allow a refund for 10 years on amounts up to 10 grand. This will free up a lot of tax appeals and ensure that regular people are treated fairly.
Well, speaking of money, if you like financial scandals, this next one's for you. The spectacular collapse of Altada is the story that just keeps on giving. This was a company that, not too long ago, was being hyped as one of Ireland's brightest tech stars. Now, they have apparently left behind debts of over 21 million euros, and reports indicate that Revenue has opened its most serious level of investigation. Level 3, that's basically the financial equivalent of the Gardaí kicking in Nidge's door in love-hate, catching him mid-scheme, right?
Yeah, it's not what you want to see. It means Revenue suspect significant tax fraud or financial mismanagement. They're not just checking receipts anymore, they're calling in forensic accountants, pulling bank records, and if necessary, cases will be referred to the DPP.
Yikes. Daphne, you've been tracking this financial soap opera. What exactly are the reports saying about Altada's alleged spending spree?
Oh, where do we even begin? The liquidators report reads like the itinerary of an A-list celebrity. We're talking private jets, first-class flights and five-star hotels, but that's just the start. There were designer shopping sprees, luxury car rentals, yacht parties, and even 10 grand a night villas. And let's not forget those mystery payments linked to a private school in Cork.
At this point, I have to ask, was Altada actually an AI company, or was it just an elite travel agency for its execs?
Of course, these remain unproven allegations, but the claims of lavish spending are sure to have angered those who invested in the company.
So what happens now? A gentle slap on the wrist? Or are we talking about the financial equivalent of a full-scale crime drama?
Much more dramatic. If you're on the receiving end of a level 3 investigation, you're not just dealing with an audit. This is when revenue suspects there could be tax fraud or financial misconduct involved, though no formal charges have been brought at this stage. And crucially, it removes the taxpayer's ability to make a qualifying disclosure to reduce penalties. Basically, if you've hit level 3, you're now in potential prosecution territory.
If someone finds themselves in this situation, what should they do?
Don't engage with revenue directly, because anything you say could be used as evidence against you.
This isn't the time for DIY legal advice. Revenues investigators are thorough, and any misstep could make things far worse.
Let's end on this golden rule then. If you find yourself in a level 3 investigation, hire a tax expert and stay stum. Right, Derek and Daphne, it's time to turn our focus to the main subject of this episode. In the last episode, we were talking about the taxation of property. We discussed a key distinction that affects rates of tax, whether the property activity is trading or investment in nature.
So, Josh, to finish the discussion on the tax treatment of property activities, there's a case that's relevant for anyone involved in government contracts, and it's a good refresher on income classification and tax rates.
All right, give me the details.
So, the appellant was running emergency accommodation under an agreement with Dublin City Council. Initially, they assumed they were simply earning rental income, meaning they'd be taxed at the highest rates for investment businesses. But revenue had other ideas. Instead of passive rent collection, they saw an active, service-driven operation, one that should be taxed as trading income.
And that's where things get interesting. Some people might panic at their property income being reclassified, but as we've discussed already, this could actually be an advantage. Trading income isn't just taxed differently, it's often taxed more efficiently with perks like reinvestment opportunities, deductible expenses, and potentially lower profit tax rates.
If you're playing the long game in property, structuring your income as trading rather than rental could be a strategic goldmine. It opens doors to capital allowances, business reliefs, and corporate structuring advantages that you just don't get with standard rental income.
So what we're saying is, this isn't just some boring tax technicality. It's a potential game changer for anyone in property. Love it.
This case provides a blueprint for property owners who want to take control of how their income is taxed, rather than just accepting whatever box revenue puts them in.
All right, so what tipped the scales? What made revenue say, hey, this ain't rental income, this is a full-blown business?
The key factor was that the appellant wasn't just leasing a property and collecting rent. They were actively managing a full-service accommodation. They had 24/7 staff. They maintained detailed occupancy records. They furnished the units, covered utilities, and they even handled weekly linen changes. On top of that, they ensured fire and safety compliance and provided designated spaces for visiting professionals like social workers and doctors.
So that's not just a landlord collecting rent, it's a fully managed business. The level of service was integral to the setup, not just an incidental extra. In this case, you don't just have a property rental with a few perks. The day-to-day operations were quite intensive. Another key factor was exclusive possession, or more accurately, the lack of it.
Why does exclusive possession change the game?
Because exclusive possession is one of the clearest indicators of a rental agreement. In a typical lease, the tenant controls the space and the landlord stays out. But here, that wasn't the case. The appellant still had access to communal areas and even bedrooms in emergencies.
And that's where it stopped looking like a typical lease and started looking like a managed service business. The occupants weren't tenants in the traditional sense, they were guests or lodgers staying under structured rules set by DCC and enforced by the appellant.
So when you don't have exclusive possession, you're not just a landlord, you're running a business. Makes sense. And what about the legal setup? Any surprises there?
That's the interesting part. There was no formal lease, no fixed rental terms, and no clear landlord-tenant obligations. Instead, everything was dictated by DCC, with the appellant deeply involved in daily operations.
No formal lease, no fixed terms. Sounds more like a handshake deal with a whole lot of responsibilities.
It's actually more common than you think. We've plenty of clients operating under unsigned agreements with government entities.
For all the property owners listening, what are the big takeaways here?
Consider whether positioning your income as trading income could work to your advantage. If you actively manage property, provide services and retain operational control, you're already on the path to trading status. And that comes with greater flexibility and lower tax rates.
Right. But if you don't structure things properly, if you just assume revenue will see things your way without laying the groundwork, well, that's like leaving a dog leg in your defence line, and we all know what happens next.
Shh.
Revenue will hit that gap faster than Bundyaki. 1 second you're kicking for territory, next you're watching them run through for a try.
Last thoughts before we move on.
If you're running a managed accommodation business, or you think you might be, do a tax NCT, a health check for your taxes, and fix any issues that could keep you from getting the best tax treatment.
But there's another tax tripwire lurking in the shadows, one that gives revenue an open shot at your margins. I'm talking about VAT. Now, plenty of landlords and Airbnb operators think, VAT? That's for hotels and the big developers. But Derek, that's not quite the case, is it?
Well, there are two VAT systems. A VAT system for property, which is a whole podcast series in itself. This shouldn't be confused with the system of VAT that applies to trading activities, which is what we're talking about here. For trading activities, the key performance indicator is gross annual turnover. Once trading activity goes above 40 grand in gross annual turnover, the activity is subject to VAT, and then the maths change.
Let's start with the big players, those running multiple short-term lets, leasing entire buildings, or working with government contracts. How does VAT hit them?
Let's say you're leasing apartments under a government contract or providing emergency accommodation. Your activities might be VAT exempt.
If the accommodation is in a house, apartment, or similar establishment, it's VAT exempt. Likewise, if it operates more like a hotel or guest house, but is exclusively contracted to a state agency for refugee housing, it's also VAT exempt.
So no VAT at all?
Pretty much. And additional services like security and laundry, if they're bundled into the accommodation, they're also VAT exempt. But catering, different story. That stays VATable, usually at 13.5%, sometimes even 23%.
That's why property owners need to review their contracts and service structures. Make sure they align with VAT exemptions and don't trigger unexpected tax bills.
And if there's a problem?
You can't just hike the rent to cover it. Government contracts fix the rates. So if you suddenly owe VAT, that's coming straight off your profits.
Oof, that's brutal if you're running on tight margins.
If your pricing is locked in, VAT isn't just a tax, it's a structural problem that can completely reshape your business model.
Worse still, if you haven't charged VAT but later find out your activities or part of them are VATable, the hit to your bottom line can be significant.
So for the bigger players, it's a balancing act. VAT needs to be factored into pricing, contracts and investment strategy, or it'll chew right through the margins.
Larger operators are used to VAT due diligence. They'll run the numbers before acquiring a property or structuring a development. VAT isn't just a cost, it's a tool. With the right strategy, group structures, opting to tax, reclaiming VAT on developments, you can turn it into an advantage.
That's why clients work with VAT experts like us. VAT is a key element in financial planning.
All right, but what about the smaller operators? The folks with a couple of Airbnbs?
That's where people get cut out. The second your short-term rental income goes over 40 grand, boom, you're in the VAT system. And that means charging VAT on every single booking.
Let's make this real. So let's say I've got a nice little Airbnb setup. Nothing massive, just a few short-term lets. I'm making, 38, 39 grand a year. No VAT worries, right?
Right, until you go over 40 grand. The moment you cross that threshold, you're in the VAT system. And suddenly, 9% of what you charge your guests now belongs to revenue.
So let's put some numbers on this. Let's say I was charging €100 a night. Once I hit 41 grand turnover, I now need to charge VAT on every booking. I can either increase my prices to €109 per night and hope customers don't run for the hills, or absorb the VAT myself, meaning my take-home drops to €91 per night.
It's like thinking you've scored a crucial try for England.
Hang on a second. Are we just using this podcast as an excuse to remind me that Ireland keep beating England?
I mean, we wouldn't say it outright, Josh, but if the boot fits.
Look, we're just saying, much like VAT, sometimes you think you're in the clear and then Irish revenue comes flying in and ruins your day.
This can lead to a classic pricing dilemma. Small operators don't have the pricing power of big hotels. If you're competing with 50 other Airbnb hosts, hiking rates could rub out your profits.
So VAT registration can actually make smaller operators less competitive, unless they're big enough to reclaim VAT on their expenses.
But here's the kicker, it rarely works out. Yes, VAT-registered operators can reclaim VAT on some expenses, cleaning, repairs, professional fees. even certain utility costs. But their bigger cost, the mortgage, there's no VAT on that. So in reality, they're handing over euros while getting pennies back.
And that's where scale matters. Bigger operators can structure their VAT position efficiently, but for small-time landlords, VAT is often just a straight-up financial hit.
So, key takeaway. Small operators need to monitor that 40 grand threshold like a hawk, while bigger players need to build VAT into their contracts and pricing models.
That's why we're here, helping operators crunch the numbers, strategize their options, and sidestep VAT landmines before they blow a hole in their profits. The game is all about knowing when to pivot, when to play safe, and when to take the hit and move on.
To complete the tax picture, let's discuss the estate planning implications of trading versus investment treatment. But first, let's take a short break.
Running a business means making big decisions. And when it comes to taxes, those decisions can have a lasting impact. Whether you're navigating complex property transactions, planning a corporate restructuring, or optimizing shareholder remuneration, you need a strategy that works for you. At CoVenture Tax Consulting, we specialize in tax planning solutions tailored for businesses. Our team of experts helps you tackle the complexities of property deals, corporate reorganizations, and shareholder planning, all while ensuring you stay compliant and maximize your financial outcomes. Your business deserves more than a one-size-fits-all approach. Partner with CoVenture Tax Consulting and unlock tax strategies that align with your goals. Visit coventure.ie, your trusted partner in smarter business tax planning, to schedule a consultation.
Welcome back, folks. The grand finale of our two-part deep dive into property taxation. Last time, we went all in on business structures and VAT. Now, we're switching gears to something that sneaks up on a lot of business owners, inheriting and gifting property, and in particular, business relief. Daphne, for those who haven't spent their weekends buried in tax law, what exactly is business relief?
It's one of the most valuable tax breaks out there. It can slash inheritance and gift tax on business property from 33% down to just 3%. But there's a catch. You only qualify if the business is mostly trading, not just holding investment assets.
So the distinction we've been hammering home in this series, the difference between trading and investment, is just as crucial for estate planning as it is for everyday tax planning.
Yeah, and here's where it gets tricky. The line between trading and investment isn't always obvious. We've seen cases where a seemingly small distinction makes all the difference between securing business relief and getting hit with a huge tax bill. There's a well-known tax case where a family running a holiday letting business tried to claim business relief when passing the business on.
They argued they were actively running a business, cleaning, handling admin, managing bookings, but revenue wasn't buying it.
Just offering a few services isn't enough. To qualify for relief, more than 50% of your business must be trading activities.
Which brings us to another case. A holiday let operation that thought they were in the clear because they partnered with a nearby hotel to offer services like cleaning, check-in and food options.
They thought they had cracked the code, but they were still offside. The court ruled that guests were primarily paying for the accommodation, not the extras. No business relief.
That's why the courts focus on what's driving the revenue. It's not just about having services, it's about whether those services transform the business from an investment play into a trading operation.
So if most of your income comes from owning property and the services are just a supporting act, you're still in the investment zone. But then there's the case where the taxman took a hit. Daphne, tell us about this one.
This was a livery yard business where revenue tried to argue it was just renting land, but the business owner pushed back hard. They weren't just providing space, they were feeding the horses, managing health checks, handling worming programs. It wasn't just a field, it was a fully managed equestrian business.
And the court sided with the taxpayer. This case proved that land-based businesses aren't automatically investment operations. If there's real, hands-on daily management, business relief can be justified.
All right, let's talk about a case where a property business actually won their tax appeal. Daphne, this one was a bit of a shock, wasn't it?
Oh, absolutely. Usually, revenue is pretty firm on classifying property-based investment as passive investment. But in this case, the taxpayer ran a holiday-let business and actually won.
How did they manage it?
This one was a game changer. Instead of a simple holiday rental, the business operated like a full-scale resort. They had a swimming pool, a games room, concierge level service, and an entire guest experience beyond just providing accommodation. This wasn't a passive Airbnb operation. It was a high-end, hands-on business where services were a core part of the offering. When the services define the business, not just supplement it, that's when you shift into trading territory.
So, if a property owner wants to avoid higher tax rates, they need to prove they're actively managing the business.
If you're just renting out space, revenue sees you as an investor. But if you're offering services, cleaning, activities, personalised guest experiences, you can argue that you're running a business, and that can be a game changer for tax treatment.
Love it. Bottom line, don't leave it to chance. Plan ahead, structure smartly, and make sure you've got the paperwork to back it up. Daphne, Derek, absolute gold as always. And that, folks, brings us to the end of this tax tour de force, a deep dive into the world of property taxation where history, legal battles, and financial strategy collide. We started with what seemed like a simple question. How do you tax property income? As we've uncovered over these past 2 episodes, the answer is far more complex. We've explored the crucial divide between passive rental income and active trading businesses. Whether you're providing emergency accommodation under a government contract or running a short-term rental, the classification of your income could be the difference between a hefty tax bill and a strategic tax advantage. We looked at VAT. If you're in the short-term rental game and cross the €40,000 threshold, suddenly VAT kicks in. And for those in large-scale property operations, structuring your contracts correctly could be the difference between keeping your margins or watching them disappear. And finally, we wrapped up with estate planning and inheritance tax, where business relief can reduce your tax rate from 33% to 3%, but only if you can prove you're running a trading business. We looked at cases where holiday let operators won and where they lost, and we saw that services alone aren't enough. It's about what drives your revenue. If there's one thing these episodes have made clear, it's that property taxation isn't just about compliance, it's about strategy. Whether you're an investor, developer, or landlord, you need to structure your income smartly, optimize your VAT treatment, and plan ahead to avoid costly tax pitfalls. So, if you're in the property game, remember this. Know your classifications, plan your structures, and stay one step ahead of revenue. If you've enjoyed it, make sure to subscribe, share, and leave us a review. And don't forget to follow us on Spotify, iTunes, and wherever you get your podcasts. If you have any questions or topics you'd like us to cover, feel free to reach out. Until next time, keep your finances in check and your tax knowledge sharp.
If you enjoy Irish Tax Unwrapped, please rate, subscribe, and share the podcast. If you've any questions or topics you'd like us to cover, please contact the show on X @TaxUnwrapped or email the show podcast@taxiq.ie.